Hi, I'm Amy with James Hamlin and Company. We specialize in helping small business owners achieve great financial results in their business. I'm here today to talk about profit versus cash flow and how the two are not the same. We find too many business owners make decisions based on the profit they see on their P&L without looking at actual cash or a forecast of cash needed in the near term for overhead and things like possible repairs. They see the profit and erroneously assume it's there to spend. Worse yet, sometimes they will be advised by someone that they should spend their profit so they save money on taxes. Let me ask you this. Have you ever looked at your profit and loss statement and wondered why the profit doesn't equal the cash that's in your bank account? Cash flow is the key to any business surviving. It is one of the main reasons that 8 out of 10 businesses fail within their first 5 years because they did not understand the difference between cash flow and profit, or if they did not manage the cash flow well enough. Cash flow is like the oil in the engine of a car. It is a lubricant to take the heat away and keep the moving parts moving fluently. If there is no oil, the engine will lock up and be destroyed in quick time. The same goes for businesses without cash flow. This is why every business owner should understand how to manage cash flow, as this is the real life picture of dollars going in and out of your business. There are several reasons that contribute to your profit not being the same as your cash on hand. Some of the more common reasons include accounts receivable. Your P&L takes in account all sales made in a given time frame, whether you were paid at time of sale or at a future date. You see, for many businesses, sales are made with terms, meaning you account for the sale today, but you are actually paid 30 days later or at some point in the future. Subsequently, your sales, which are made on a future promise to pay, reflect in revenue on the P&L, but the cash is not in hand. This point really demonstrates the importance of efficient collections and AR management. Buying inventory. You may be making a profit, but if you do not have great stock control, you'll have all your money tied up in inventory. Remember this important point. Profit is reflected on your earnings statement or P&L. Inventory is an asset, and it shows up on your balance sheet. When you buy inventory, you use cash. So cash goes down and inventory on hand goes up. Neither transaction is reflected on the P&L, which is another contributing reason why your profit is different than your cash on hand. Non-cash items such as depreciation that appear in your profit and loss statement contribute to the discrepancy between profit and cash. Depreciation is a theoretical expense that you are allowed to take on assets. I say theoretical because you don't actually spend the cash. It's a deduction the IRS allows for in your business. Depreciation reduces the profit reflected on your P&L, even though it wasn't an actual expense that took cash out of hand. This is a third common reason for the difference between cash and profit. One important point to remember about depreciation. Depreciation is money that is meant to be saved, so when an item needs repair or replacement, you have the money to replace it. There are other contributing factors to the discrepancy between cash and profit in your business. The key is that there are many factors to consider before making a purchase decision, a distribution decision, or a decision to pay down debt. Generally speaking, it can be a big mistake to distribute all the profit from your business. And one of the biggest is overlooking the key contributing factors that cause the profit and cash in your business to be different. Another big reason it's a mistake is because you are decreasing the curb appeal of your business when you deplete all the profit. We'll have more about this in an upcoming video. In the meantime, we are here to help you. Contact us, James Hamlin and Company, your trusted advisors, and we can talk specific strategies to help you manage better cash flow.